Okay, so you get the call on a Tuesday. Nothing dramatic, just a calendar invite titled Quick Chat from someone in HR. You already know. 50 years old, 19 years at the same company, $240,000 still owed on the house. Here's what the real numbers actually show. Picture a 50-year-old named Mark. Not a real person, just a stand-in for a story that plays out in kitchens across the country every year. Mark makes $92,000 a year. His mortgage payment is $2,100 a month. He has $11,000 in a checking account and $60,000 sitting in a 401k he hasn't touched since his last job change. Severance gives him 8 weeks of pay. That's about $14,000 before taxes. It feels like a cushion. It is not the cushion it looks like. Here's the part almost nobody accounts for. The moment Mark's paycheck stops, his health insurance goes with it. COBRA, the law that lets him keep his old employer coverage temporarily, doesn't subsidize anything. He now pays the full premium himself. For a family of 3, that's roughly $1,800 a month, just to keep the same coverage he had for free last week. There is a cheaper option. The health insurance marketplace, sometimes with income-based subsidies, can bring that number down. But it takes research, paperwork, and time Mark doesn't feel like he has in week 1. Most people default to COBRA simply because it's the path of least resistance, even when it quietly costs them hundreds more a month than a marketplace plan would. Add the mortgage, add COBRA, add groceries, gas, a car payment. Mark's monthly baseline expenses land around $5,200. His severance runs out in 10 weeks. What happens in week 11? This is where the math turns from uncomfortable to sobering. Mark starts pulling from savings. $11,000 disappears in about 6 weeks at that burn rate. Now he's looking at the 401k. He hasn't retired. He's 50. If he withdraws early, the IRS doesn't just tax it as income. It adds a 10% penalty on top. Pull out $20,000 and roughly $7,000 of it evaporates into taxes and penalties before it ever reaches his mortgage payment. Let's decode that term while we're here. A 401k penalty exists because that money was never meant to leave the account before age 59 and a half. The government gave Mark a tax break to save it. Taking it out early means giving that break back, with interest, in the form of a penalty. So, what's Mark actually left with? If the job search takes 4 months, which is close to the national average for someone in his age bracket right now, he needs roughly $21,000 beyond his severance and savings just to keep the lights on and the mortgage current. To get that from his 401k, after taxes and penalties, he'd need to withdraw closer to $30,000. That's half of what took him years to build. And here's the twist almost nobody plans for. Job searches at 50 don't move at the same speed they did at 30. Some of that is bias in hiring. Some of it is that senior roles simply take longer to fill. And some of it is that Mark is now more selective, because a wrong move at 50 is harder to undo than a wrong move at 30. If his search stretches to 6 months instead of 4, that $30,000 withdrawal edges closer to $50,000. Add a market downturn to the mix, the kind that knocks 10 to 15% off retirement account balances in a bad year. And Mark isn't just spending down his 401k. He's spending it down while it's shrinking. This is the number that should make anyone pause. A $50,000 early withdrawal, taken during a market dip, can represent a loss of well over $100,000 in future retirement value once you account for the money itself, the growth it would have earned, and the timing of pulling it out while the market is down instead of up. There's a quieter cost too, one that doesn't show up on a spreadsheet. Every week the search drags on, the pressure to say yes to the wrong offer grows. A role that pays 15% less. A commute that eats another hour a day. People in Mark's position often take the first thing that comes along. Not because it's right, but because the alternative feels like watching the 401k drain in real time. That decision, made under financial pressure instead of career logic, can quietly cost more over the next decade than the job loss itself. Before you picture your own version of this, remember, these are illustrative figures built around a hypothetical scenario. They're meant to show how the pieces connect, not to predict your specific numbers or replace advice from a licensed financial professional. So what actually protects someone in Mark's position? It isn't a bigger severance package. Severance is out of his control. What's in his control is the emergency fund, sitting there months before the calendar invite ever shows up. Financial planners who work with people in their 40s and 50s often point to a specific target: 3 to 6 months of full expenses, mortgage included, sitting in cash, untouched, boring, and completely unglamorous. For Mark, at $5,200 a month, that's somewhere between $15,000 and $31,000. Money that never has to touch a 401k, never triggers a penalty, and buys time without shrinking future retirement income. There's a second layer too. Mortgage lenders have hardship and forbearance programs, ways to pause or reduce payments temporarily during a job loss without immediately risking the house. Most homeowners don't know these exist until they're already behind. Knowing the option is there before you need it changes the entire timeline of a crisis. There's a fourth thing worth naming, even though it's uncomfortable. Telling your spouse or partner in week 1, not week 8, changes everything about how a household handles this. Households that talk about the number early, together, tend to cut spending faster and borrow smarter than households where one person is quietly watching the balance drop alone. Silence doesn't protect anyone. It just delays the moment the real conversation has to happen, usually until there are fewer good options left. There's a third layer that costs nothing and almost nobody sets up in advance. A simple list of every fixed monthly expense, ranked by what can be paused, negotiated, or delayed if income stops tomorrow. Streaming subscriptions, a second car payment, a gym membership, none of it moves the needle much on its own. Together, trimmed in week 1 instead of week 8, it can buy an extra month before the 401k ever gets touched. The families who weather this best aren't the ones with the highest income. They're the ones who already knew, before the crisis hit, exactly where their money could bend. And there's a mindset shift underneath all of it. The instinct in a job loss is to protect the house at any cost, even if that cost is gutting a retirement account that took 2 decades to build. But the house and the retirement account aren't actually in competition. The real competition is between reacting in panic and having a plan already sitting in place before the invite ever lands on the calendar. Mark's story doesn't end in week 11. Most stories like his don't. He finds something. Maybe it pays a little less. Maybe it takes 5 months instead of 4. But the version of Mark who had 4 months of expenses saved walks into that period completely differently than the version who didn't. Same job loss, same age, same mortgage. Completely different outcome decided months earlier by a decision that felt too cautious at the time. Think about your own numbers for a second, not Mark's. Yours. How many months of your mortgage, your groceries, your insurance could your current savings actually cover if the invite showed up tomorrow? Most people have never run that number. It takes 10 minutes and a calculator, and it's the single most useful 10 minutes you can spend before you ever need the answer. You don't get the calendar invite until you get it. But the $50,000 difference between panic and preparation gets decided long before that Tuesday ever arrives.